Hi there, Brian here from the Cash Flow Desk. Today, we're breaking down one of those finance distinctions that sounds simple but trips up a lot of business owners: CapEx versus OpEx. If you've ever wondered whether that new software subscription counts as a capital expense or an operating expense, or why it even matters, this video will clear it up. We'll cover what each one means, how they affect your financials differently, and why getting this right can save you money and headaches down the road. Let's start with CapEx, capital expenditures. CapEx refers to money spent on assets that will benefit your business for more than 1 year. Think equipment, buildings, vehicles, or major software implementations. The key characteristic here is longevity. These purchases don't just help you this month or this quarter, they're investments that should generate value for years. A manufacturing company buying a new production line for $500,000? That's CapEx. A law firm purchasing office furniture and computers for $25,000? Also CapEx. Here's what makes CapEx different. Instead of hitting your income statement all at once, these costs get spread out over time through depreciation. You're essentially matching the expense with the periods when you'll actually benefit from the asset. Operating expenses covers the day-to-day costs of running your business. These are expenses that get consumed within a year. Office rent, employee salaries, utilities, software subscriptions, marketing spend, all OpEx. The defining feature is that these expenses support current operations. They keep the lights on and the business running, but they don't create lasting assets. A SaaS company paying $10,000 monthly for cloud hosting? That's OpEx. An e-commerce business spending $50,000 on digital advertising this quarter? Also OpEx. Unlike CapEx, operating expenses hit your income statement immediately. They reduce your profit in the period when they're incurred, which gives you a clearer picture of what it actually costs to run your business month to month. Now, here's where it gets interesting, and why this distinction matters for your bottom line. CapEx shows up on your balance sheet as an asset, then gradually moves to your income statement through depreciation. This means a $100,000 equipment purchase might only cost you $20,000 per year on your P&L if you depreciate it over 5 years. OpEx, on the other hand, hits your income statement right away. That same $100,000 spent on operating expenses reduces your profit by the full amount in the current period. This creates very different cash flow and profitability patterns. Heavy CapEx years might show strong profits but tight cash flow. Heavy OpEx periods show exactly what they cost in real time. For tax purposes, this matters too. OpEx typically provides immediate deductions, while CapEx gets deducted over several years through depreciation schedules. Let's make this practical with some examples. Consider a growing tech company deciding between buying servers for $200,000 or using cloud services that cost $4,000 monthly. The server purchase is CapEx. It goes on the balance sheet and depreciates over, say, 5 years. That's $40,000 annually hitting the income statement. The cloud services are OpEx. $48,000 per year hitting the P&L immediately. Same with office space. Buying a building is CapEx. The mortgage payments include both interest, OpEx, and principal, CapEx. But leasing that same space, pure OpEx. Here's a tricky one: software. A perpetual license for $50,000 is typically CapEx. But that same software as a monthly subscription for $2,000, that's OpEx, even though you might spend more over time. Understanding this distinction helps you make smarter financial decisions. CapEx tends to improve your asset base and can provide better long-term economics, but it requires more upfront cash and can strain short-term profitability. OpEx offers more flexibility. You can scale up or down based on business needs, and you get immediate tax benefits. But you don't build equity, and costs can add up over time. Many businesses are shifting toward OpEx models. Think cloud computing instead of servers, or leasing instead of buying equipment. This preserves cash flow and reduces risk, but it can mean higher total costs over the long run. The sweet spot depends on your cash position, growth stage, and strategic goals. A cash-rich, stable business might prefer CapEx for better long-term economics. A growing startup might choose OpEx for flexibility and cash preservation. A few things to watch out for. Don't assume expensive equals CapEx. A $30,000 marketing campaign is still OpEx because it doesn't create a lasting asset. Be careful with software and technology purchases. The accounting treatment often depends on implementation costs, customization, and whether you own the underlying asset. And remember that CapEx decisions are harder to reverse. Once you buy that equipment, you're committed. OpEx gives you more room to pivot if business conditions change. Also, don't let tax considerations drive the decision entirely. Yes, OpEx provides immediate deductions, but CapEx might offer better long-term returns and asset building. Here's the bottom line. CapEx and OpEx aren't just accounting categories. They're strategic tools that affect your cash flow, profitability, and financial flexibility. Capital expenditures builds assets and can provide long-term value. Operating expenditures keeps operations running and offers flexibility. The right mix depends on your business model, growth stage, and financial position. If this helped clarify things, hit like and subscribe. Drop a comment with what finance topic you'd like us to tackle next. Thanks for watching. I'm Brian, and I'll see you in the next one.